We're going to
Right.
jump right to this week in trading history. And so I wanted to do, I was torn between doing two different segments, right? We're going to talk a long-term capital in just a moment. But the other this day in history kind of story that was really interesting was the establishing of the U.S. Treasury Department back in 1789 in the U.S. happened on September 2nd, and that's 1789. But what's interesting is Alexander Hamilton was named the first Secretary of the Treasury, and it was William Duer that was became the first Assistant Secretary. But the funny part of that story, which why I had to mention it, is that William Duer got basically got caught in a very speculative position, ended up actually blowing himself up, and spent the rest of his life in debtor's prison.
Nice.
So the first Assistant Secretary of the Treasury of the United States spent his days in debtor's prison. I thought that was anyway.
That is interesting. I have 1 second before we go on to the next topic. I have one question for you.
Tell me.
Do you think Mrs. Mnuchin would stay with good old
No, absolutely
Mr.
not.
Mnuchin if he was in debtor's prison?
Well, it actually depends, because if she was riding his wallet while he's in prison, then what?
Patrick, I'm shocked that you don't think that she's with him for his sparkling personality. Okay, let's go on to the next.
All right. So anyway, this week in trading history, what we did want to really feature is long-term capital management. And it was on September 2nd of 1998, just over 21 years ago, that John Merriweather, head of the long-term capital, sent out that letter to investors saying that the fund has lost $2.5 billion, or half of its value that year.
It's just a flesh wound.
Just a flesh wound, 52%. Yeah, we'll fight another day. And yeah, that was the story. For those of our listeners that don't are listening to the podcast and don't see the picture, like Kev, you did a really funny macro tourist picture here. Why don't you tell everyone?
Oh, because it was there's a great picture that I dug out. It was the picture of the long-term capital senior staff huddled around these huge CRT monitors, looking very intent and looking at their positions. And I put a little headline in there. It says, okay, so we're short the 30-year swap spreads, short S&P 500 index vol, long risk arb spreads, and stuffed to the gills with emerging market debt. We're in good shape.
The original VIX sellers, right?
That's right. And I missed the part, the original VIX sellers, because they, optionseller.com had nothing on these guys.
Oh, nothing on them. Like, what a story, right? Because it was actually the first too big to fail scenario that happened. Was there one before that?
Well, no, they let them fail, but they definitely had the first one that they were worried about an individual firm pulling down the whole system.
Right.
And one of the real problems was the fact that there was a lot of copycats out there. So it wasn't just long-term capital, but also Goldman Sachs, and I think even Lehman had some, and I don't know if Bear Stearns had some, but there was definitely a lot of copycat traders with all the same positions. And actually, that was one of Merriweather's big complaints, was that as these guys were trying to save them, they were merely front-running their positions.
Okay. Yeah, that would make sense, right? But ultimately, they got zeroed. But what was interesting, so there was that book written, and so those of our millennials that weren't around or following the markets when this happened, there's a great book written on this, right? When Genius Failed. Yeah,
and that's the thing. This firm was, for those who aren't familiar with it, was supposed to be the smartest and the brightest of all. Like it had Nobel laureates. It had the original. John Merriweather. For those who don't know, that he was the character in Liar's Poker that challenged Goodfriend to the game of Liar's Poker. And he's legendary in terms of his ARB group, and Salomon Brothers made more money than I think the rest of the firm some years. Yeah. So it was a these are just iconic figures. And this, when he went out to make his own firm, and one of the reasons he went out to make his own firm was because it was actually in the aftermath of the bond rigging scandal from Salomon Brothers, where another trader had gone and put in orders for too much. On every Fed, what is it? Actually, it's not the Fed; it's the Treasury auctions for the bonds. He had overstated the pro account, the firm's account, and in doing so, had broken all sorts of rules. And then Salomon Brothers got their hands cuffed and are tied because of the regulations. And then Merriweather decided he was going to go out and start his own firm, which was Long-Term Capital Management.
And then there's Myron Scholes, right?
Myron Scholes, the Black and Scholes option theorist. And there's all these really, really smart guys. And so I actually was laughing when I was reading through. And when they started, in 1994, they had 30 traders they hired right off the bat, Patrick. And my favorite stat is that $10 million they spent in SunSpark servers. You probably don't even know what a SunSpark server is. But on the desk back in like even I used SunSpark servers as well. I remember that we had one that cost $50,000, and back in the 90s, $50,000 was a lot of money. And think about that, $50,000 on a computer that would just be sitting on your desk. And these were Unix-based systems, and they were a lot better than Windows, because back then Windows was shit, and you just couldn't rely on it. No, you couldn't. It was the blue screen of death, and there was no way you could go do any serious math or rely on it for any sort of trading. So all the really big kind of really important guys would go buy these SunSpark servers, but $10 million. That's like everyone had one, it seems like. That seems like a crazy number to spend.
Yeah.
Yeah.
That's crazy.
They ended up zeroing themselves, though, because they put on
we're going to talk about that, right? Like, we're going to save that for our
right. But,
tales.
Let's talk about what they were doing. And I kind of laughed about it on my little meme there, the picture that I created. But a lot of the trades that they really hurt them, although a lot of people focus on the Russian default being the trigger that caused the spiral set in motion, it was really, I think, I can't remember exactly, but I think it was the swap spreads that really hurt them the worst. And what's interesting is the swap spread is nothing more than the difference between bank funding and government government funding. And I think they were trading at I don't know. I think they were like 40 or 50 and basis points, and they thought they should go to zero. So they were short the swap spread in big time. And the thing about it is that this was a very illiquid instrument, and I think it's what happens is in the summer, everyone goes away, and then next thing you know, people are moving stuff around, and it starts getting marked against you, which I think is part of the reason of what happened recently this summer with bonds. A lot of the things just started going, and that was it. But anyways, back to the swap spreads. We go look, and they blew out, and they had been trading at 40 basis points on the 10-year. During the long-term capital management thing, they blew out to 98.
Wow.
And then eventually they went even wider at 140. And for the longest time, it's actually really interesting because swap spreads theoretically should widen in a crisis. And that is initially what happened during the problems in the great financial crisis. We saw, swap spreads move from 40 all the way up to 80 during the financial crisis. But what's interesting is after that, and in the ensuing months after the great financial crisis, they actually went negative. And swap spreads should never go negative because you should never have a situation where bank credit is trading lower than government credit. Because the government always should have less, there should be more of a risk from bank credit. And so it just kind of illustrates the crazy stuff that these guys were trading and the fact that it really doesn't have that much to do with reality. And it had more
theory
to do with
versus
flows.
reality. When you have PhDs, they have theories.
Right.
And reality is that there's a counterparty to every one of your trades. And in the end, when you trade as big as they were, those counterparties are huge. And the thing is that you're not going to have natural price discovery because the participants are all wound into these massive positions on either side, and they're not
Yeah,
going
but
to let up.
Yeah, they've been all. Well, that is true as well. And there's some game theory about that occurred because people realized they were offside. But I guess the point is that they were trading in very kind of esoteric positions that really although there was great theories of why they should work, the reality is that they weren't quite as smart as they all thought they were, and they had leveraged these positions like to the moon.
Right.
Like, think about it. They were bond guys that had decided to short S&P vol. And listen, I get it. I understand why they're short S&P vol. S&P vol generally trades higher than realized vol. So on the whole, if you can position yourself correctly and do it over time, you are better off being short. But the thing is, you have to be able to stomach the pain on those spikes, and they just hadn't thought about that. And the real lesson during the long-term capital was that, and I think this was the first time it really had happened to this extent. In times of crisis, all correlations go to 1 or negative 1. And that was basically it. And that was the real problem. You wouldn't they were complaining that there's something, one of their other trades they did was an off-the-run versus on-the-run bond. And on-the-run bonds are the ones that are the latest auction, and they're the ones that everybody trades. And then there's an off-the-run, which is the previous auction or some other one like that. And those two might have a spread of like 10 basis points or something. And you buy the one and short the other, thinking that 10 basis points will eventually normalize. That trade, in times of stress, all of a sudden went to 40 or 50 or 100 basis points, depending on the maturity. And there was no reason for it. But markets can get way more illogical than they ever imagined. And that's the true lesson from long-term capital.
Hence why there could still be one more squeeze in the bond market, but we won't go there.
Exactly. Well, I haven't puked yet. That's why
there's one more.
There's one more squeeze coming because I haven't puked yet.
Now we're not done with the long-term capital. We're done with this segment, but let's move on.